Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing S&P stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 150 billion market cap. They're trading at $4.86 a share and they have 300 million shares outstanding. S&P provides credit ratings, benchmarks, and analytics in the global capital, commodity, and automotive markets. It operates through S&P Global Market Intelligence, S&P Global Ratings, S&P Global Commodity Insights, S&P Global Mobility, and S&P Dow Jones indices. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They have pretty consistent free cash flow each year. It's highest in the trailing 12 months, 4.7 billion. Really good margins. They converted 35% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also really consistent, peaking in the trailing 12 months at 3.6 billion. Revenue is a sales for the company, and that goes up each year from 8.3 billion to 13.3 billion. Really healthy financials. They pay a 0.75% dividend yield, which cost them $1.1 billion. They have $4.7 billion of free cash flow, so they can cover their dividend 4.1 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated the terminal value, it's all cash flows past year 4, that's $117 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $103 billion. We divide that by 300 million shares. And we get a calculated stock price of $3.30. They're trading at $4.86, so they're trading at a 47% premium. It's a sell according to the model. What do you think? Do you think it's overvalued or undervalued? There are 13 companies in the same industry as S&P, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend $140 million in CapEx. ICE spends the most at $600 million. A really good debt to equity ratio. For every dollar of equity, they only have 30 cents of debt. A lot better than the median average. They do pay a dividend, but it's a little lower than the median, 0.8%. Look at CME Group, 4.8%. They pay the most. S&P generates the most free cash flow in this industry. They're a big company, 152 billion market cap. A little less than number 2 and 3 combined. They're trading at 4.5 times book value, 42 times earnings, so it does seem overvalued. 32 times free cash flow, so that's a bit rich. 11 times revenue. They generate the most revenue, 13.3 billion. About 3 times the median, and they're growing more than anybody else, 16% 5-year annual revenue growth rate. Pretty impressive stats. If you put $10,000 into this company 10 years ago, you'd be really happy. At $68,000 today, that's a 21% annual return. So I'm doing a short form video. Let me know what you think. Thanks for watching.